Power Lunch. Next, Sue Herrera. And then my good buddy Jeff Macke, spending time. He's climbed out of the fast money ditches, and he's now living in the big time with Sue Herrera. Power Lunch right now.
And Dylan's right. Jeff Macke is with me. I kidnapped him from fast money. And Dylan, if you're really good, I'll give him back, but begrudgingly. Welcome to Power Lunch. I'm Sue Herrera. Thanks for joining us. Bill Griffith is on vacation this week, and Jeff is with me. And Jeff, thanks a million. It's been a terrific week to have you here.
It's been an interesting one.
Yes, and we're not done yet because we have 2 hours to go, and we'll see how it does fare on Wall Street. Because right now we have a relief rally going on. Stocks are gaining. They're well off of their highs, but they're managing to hang in there pretty good right now. We're up 133 points, 12,979. After the Fed did its move this morning. Steve Leisman's going to have more on that in just a second. Then we have our CNBC Mortgage Task Force countrywide. We posed this question in our editorial meeting yesterday here on Power Lunch. Could Countrywide be a takeover target? Is that the best way out for them? We posed that question. And then Best in Breed, we're talking about the financials. Should you buy them right now? Maybe, but you got to be really careful. We have a guy who has 3 recommendations for you. First, though, to the markets. We'll get you caught up. We had a triple-digit advance on the Dow Jones Industrial Average right after the opening bell. And indeed, we've managed to hold on to a triple-digit advance, although we are off our highs. We're up 135 points. Last trade, 12,981.80. The NASDAQ, last trade there is on the upside by 36 points at 2487.97. And the last trade on the S&P is up 20 points, almost 1.5%, 1431.64. 10-year note, the yield is at 4.66% on the trading session. As for crude oil, last trade there is up half a cent, 50 cents rather, at 71.57. That's about 0.75%. Reformulated gasoline is up 1 3/4%, just above the $2 mark. And as for nat gas, which has been all over the map, is up 1.5% now, just below the $7 mark on the trading session. Fed gives the markets a boost today by cutting its so-called discount window rate. And if you were watching Power Lunch yesterday, you could have anticipated this move. Listen.
Because the liquidity it's been injecting, because it's been injecting liquidity and not getting to where it needs to go, I'm thinking that perhaps they will lower the rate at the discount window. This is a place where they'll take almost any credits that you can offer them. It's an intermediate step. It's not a rate cut. It's better than a liquidity injection.
That's why you got to watch Power Lunch every day. Great job. Steve Leisman, our senior economics reporter, has been following the story, doing yeoman's work.
Thank you.
What's next? What does it mean for the economy?
Yeah, what are you going to do for me today?
That's it. That's how TV works. Yesterday was yesterday.
More important. By the way, just a quick thing. If you listen to Bill Poole carefully, everybody who didn't get mad at him might have gotten the signal there. He said
that's true.
He didn't want to cut interest rates or the target rate. You know he's not stupid. He's got to do something. Ergo,
they let them, well, once again, they let their emotion
get mad, folks. Listen. Anyway, far more important, there are initial signs that it was a good call, not just by me, but by the Fed, more importantly. Stocks are one barometer of the effectiveness of the Fed's decision to cut interest rates, the discount rate. But if you really want to know whether it's working, you need to look at the high-quality credit markets that the Fed is really trying to target here, not stocks. And there are initial signs of some stabilization in credit markets. Take a look here. This is the discount on mortgage insurance for AAA bonds. It had been all the way down to 88. It's up 119. Less of a discount means a little bit more willingness to take risks here. Same thing with corporate bonds. Up a point. It's not a huge move, but imagine what would have happened if Fed had not stepped in today. There could have been a free fall there. What got Fed Chairman Ben Bernanke spooked was not the blow up in subprime or in junk bonds. It was the seizure in good credit markets, like the ability of high-quality companies to finance the needs for their working cash, or the ability of a good lender to sell highly rated mortgages in the secondary market. They can't do that. You can't get a mortgage. By lowering the rate of the discount window, the Fed hopes that this good credit can get financed now. Now the good credit gets financed also at a lower rate. You can see there it was 6 1/4. Now it's 5 3/4. This is just an initial step. One trader tells me some hedge funds are using the Fed actions to get out of their risk positions. We don't want that. But another trader says it's now up to the real investors to take the next step up to the plate, and start putting some real money into these good quality credit markets. That's the key that we want to watch. Stocks are going to go up and down, but the real fear of information here is the stabilization in the high quality credit markets.
And you made the point earlier this morning that the Fed probably is not looking and targeting the stock market. They're targeting the credit market.
No, the stock market had not gotten bad enough. Just because we wiped out this year's gains, the Fed has a concern over stocks in that they feed net worth. The more money you feel like you're worth, the more money you're going to go out and spend. A huge collapse in net worth would perhaps cause you to pare back your spending. But at current rates, I mean, the Fed would have been concerned about a 20% fall in the stock market, or a 10, or a 50, but just because we wiped out this year's rates was not something the Fed was that concerned about. It was specifically the good quality credits.
I want to push back on that a little bit. Not that I don't think that you're exactly right. In the big picture, the Fed doesn't care. But the Fed nuked a lot of people who were short this market going into today. If you were short index calls on the S&P 500, which closed at the open this morning, you woke up, you felt okay, and the Fed kneecapped you, and you're probably out of business. And it doesn't feel good to say, well, this was just an accident because the Fed was focusing on the credit markets. I think that this was intentionally designed to ramp the stock markets as a function of stabilizing the credit markets, because that was the basis for the short idea on a lot of these financials. Listen, the market has to stabilize here. We're seeing some of it in the growth. We're seeing oil, which with a hurricane possibly ramping into the Gulf.
I just want to pipe in real quickly on what Jeff said. The Fed would have an interest in creating a two-way trade in something. In what you were talking about, it was only a one-way trade. By the Fed coming in and also saying, wait, we may come in again, there's now a two-way trade, which puts a bottom on the markets, which is important for the Fed.
Okay, now let's bring